The South Sea Bubble was one of the most significant financial crises in British history. It occurred during the reign of King George I and was triggered by the establishment of the South Sea Company. This company was granted a royal charter in 1711, giving it exclusive rights to trade with the Spanish colonies in South America. In return, the company agreed to assume responsibility for a large portion of Britain's national debt. The South Sea Company's stock was initially traded at a modest price, but the company's directors soon realized that they could use the company's monopoly on trade with Spain to generate significant profits. They proposed to the British government that they would take over the country's national debt in exchange for exclusive rights to trade with Spanish colonies. The government agreed, and the South Sea Company was granted the exclusive right to trade with the Spanish colonies in South America, a highly lucrative market. The company's directors soon began to aggressively promote the company's stock to investors, making bold promises of high returns on investment. The company's shares began to trade at a premium, and people from all walks of life began to invest heavily in the company's stock. The company's directors also engaged in fraudulent activities, spreading false rumors and manipulating the market to keep the stock price artificially high. As more and more people invested in the South Sea Company's stock, the stock price continued to rise. The company's directors even convinced many people to sell their existing investments and use the proceeds to purchase South Sea Company stock, claiming that the stock price would only continue to rise. In July 1720, the bubble burst. Many investors began to realize that the company's stock price was vastly overvalued, and panic selling ensued. The stock price plummeted, causing many investors to lose their entire fortunes. The South Sea Company's directors were accused of fraud and malfeasance, and many were jailed or heavily fined. The South Sea Bubble had far-reaching consequences for the British economy. Many of the country's wealthiest citizens had invested heavily in the company's stock and lost everything. The crisis led to a loss of public trust in the stock market, and many people avoided investing in stocks for several decades afterward. The government faced widespread criticism for its involvement in the scandal, and several officials were impeached for their role in the crisis. In conclusion, the South Sea Bubble was a catastrophic event in British financial history, marking one of the earliest examples of a speculative bubble and the negative effects it can have on an economy. The scandal underscores the importance of transparency, honesty, and caution in financial markets and the need for regulatory oversight to prevent fraudulent activities. The South Sea Bubble serves as a cautionary tale of the dangers of financial speculation and the importance of responsible investing.